Hi everyone. Today we launched the second of our EY European Bank Lending Economic Forecasts, which covers three main forms of bank lending across the Eurozone: consumer credit, mortgage debt and business borrowing. And as we know, bank lending is such an important barometer for economic activity and actually economic health. So to help me find out what's in store for us, I'm delighted to be joined by Martin Beck from Oxford Economics, the man behind the forecast. Welcome, Martin.
Hi, Nigel. Hi, everyone.
So maybe let's get straight into it. I mean, what are the biggest takeaways for you from this latest piece of research?
Well, Nigel, I think given the cocktail of forces that are hitting the European economy at the moment, whether it's high inflation, expensive energy, rising interest rates, depressed consumer confidence, our expectation is that the Eurozone will suffer a recession over the next few quarters. That said, we think the recession should be quite mild, primarily because of all the fiscal support that governments across the Eurozone are giving to households and firms affected by high energy bills. Given that weak economic outlook, though, it does seem inevitable that that will impact bank lending to the private sector. So we do see net lending, whether it's mortgages, consumer credit or business lending, declining next year for the first time since 2014. So that will be the tail end of the Eurozone debt crisis. That said, we don't think the decline in lending will be as severe as we saw a decade or so ago, partly because of that fiscal support I mentioned, and also because households and firms in the Eurozone, their balance sheets are in a much better position now than they might have been 10 or 15 years ago.
So a tricky year ahead, Martin, but you're hinting there that maybe the severity, duration of the downturn might not be as high impact as it certainly was in previous crises. I mean, can you give us a sense of when does the light at the end of the tunnel really sort of emerge then?
So it's quite a gloomy picture in the near term. I think now as we move through 2023, things will start to improve. In particular, inflation should start to fall across Eurozone economies. We've already seen in recent months declines in commodity prices, the price of oil, gas, shipping costs have come down. And over the next few months, those developments should start to feed through into lower prices in the shops. And I think as inflation falls back, as the European Central Bank feels less need to keep raising interest rates, that should feed through into a better outlook for the consumer sector. It should feed through into stronger consumer and business confidence. And we should see net bank lending in the Eurozone return to growth in 2024.
And maybe we talk thematically then around the Eurozone as a whole, but clearly I'm sure there are some differences as well between some of the major markets. So can you give us a sense of maybe a bit of the headlines around the compare and contrast between the Eurozone markets?
I think if we drill down into the kind of country level picture, there's a couple of interesting observations. One is around Germany. Germany is typically seen as the strongest Eurozone economy, but I think the nature of the shock hitting Europe at the moment and the structure of the German economy means that Germany is probably more exposed to a deeper recession and a bigger fall in bank lending than some of the other big Eurozone economies. I mean, Germany is a very industry and manufacturing heavy economy. It's more exposed to high energy prices and disruption to energy supplies. Conversely, if we take a country like Italy, typically seen as perhaps one of the more vulnerable Eurozone countries economically, sure, Italy's got its vulnerabilities, but it's actually got quite a good picture when it comes to household and corporate balance sheets. Firms and households paid down a lot of debt during the 2010s following the Eurozone debt crisis. They're probably in a better position now to keep borrowing to support spending and demand than may have been the case certainly 10 years ago. So Italy typically seen as a vulnerable economy, but perhaps not quite as vulnerable as some people think. Given the kind of market uncertainty we've got in Europe at the moment, given the influence of geopolitics on the continent, how do you see banks operating over the next few years?
Well, as you say, it's going to be a tricky year next year, but I think, as you've outlined, the sort of shape and the duration of that downturn isn't going to be as sort of long-lasting or severe as certainly the 2008 financial crisis. So in that sense, there's a little bit of comfort to be drawn from that. In that, I don't expect actual levels of provisions, non-performing loans to go through the roof. I think it's going to be a more manageable increase, but there will undoubtedly be an increase there and an impact on balance sheets. I think the big observation is probably that the banking sector is much better capitalized than it was 10 years ago. It spent the last decade really building up those capital buffers, and I think also a protracted era of low interest rates has really forced the banking sector to diversify their revenue streams as well. And so I think they are, again, more resilient when faced with those kinds of economic shocks. And then maybe finally, in the short term, the fact that interest rates are actually rising gives them an additional sort of income and profit buffer as well to weather the storm. Martin, thank you very much for joining me. Those are just the headlines, a brief sort of snapshot of what I think is a really interesting paper, and we look forward to hearing from you and seeing you at the next video. Thank you.